In this video you will be able to see how simple trades can be made using the correct tools and the attention to the right kinds of details in the price chart. Here we have a 15-minute chart of the Australian dollar versus the US dollar. By noticing the marked numbers on the chart, you will be able to observe the most prominent highs and lows, and the appearance of three distinct price vectors. The largest vector in the chart starts in low number 2 and ends in high number 3. This vector is responsible for breaking the high number 1, and this fact sends us a very important message about this market. If we pay attention to price, we will see that the vector from number 1 to number 2 is composed of sellers trying to bring the market down, and the largest vector we talked about previously is precisely the opposite of that. If we think about market players and their respective strength, there should be no doubt about which one of them is stronger in this particular situation from number 1 to number 3. The job of a professional trader is to identify which one of the market players is stronger, and the origin of the movements that lead to such conclusions. By simply analyzing the two vectors, we can see that buyers are a lot stronger than sellers just by observing the difference in magnitude between the two vectors. In an uptrend, the vectors created by the buyers will be larger by definition, and that's why the market oscillate up and down with a tendency to the upside. The opposite is also true for downtrends as well. In the light of these simple and logical ideas, we can conclude that this market is trending upwards. A more precise way of defining this scenario is to say that we have strong buyers around number 2, which is the origin of the large vector. When we study supply and demand, it's sometimes counterproductive to use the idea of trends. The best way of trading is to think about pockets of supply and demand because trends can shift very quickly. The area around low number 2 is where we have a pocket of demand, which means an area where people might want to buy the market. This is based on the basic principle of technical analysis that the future tends to repeat the past. Knowing that we have an area of demand is obviously useful, but we need to narrow it down to a smaller zone or even a single line if we want to trade this area effectively. The study of how we can narrow down the supply and demand zone is detailed, and it's going to be one of the focal points of the price action trading course that is being produced. In this case, we can point out two elements. Near the low number 2 we can see a support and resistance line that has been tested and switched multiple times. These lines are often useful to determine the upper and lower limits of supply and demand zones. Observe how the price action in number 4 comes back to this support and resistance line and treats it like a barrier by touching it a few times and creating several lower tails that imply demand in that area. The other line that has been drawn in the chart is a turning point line, which is a little more difficult to understand because it can take several different forms. A turning point line is a single line that represents the internal breakpoint between two price vectors. The inside of a downward vector is observed in its highs, and the inside of an upward vector is observed in its lows. Notice that we have a minor flow from number 3 until number 4. The great question that you will find yourself in many times as a trader is which of the flows will win over the other. We have a major flow going up and a minor flow going down. The technical answer is that major flows are stronger than minor flows, but every rule has its exception. Sometimes the minor flow will win over the major, but that's a different story. The fact is that number 4 is an opportunity to go long in this market if we decide to believe that there is in fact a strong area of demand in that level. This is one of the most basic trades you can make in any market and any time frame because it's based on the inherent supply and demand mechanism that drives any market. After seeing some touches of the alleged demand area, you can open a long trade with a stop below number 2. Observe also how there are multiple reversal divergences happening in number 4. This is yet another indication that price might turn to the upside in alignment with the current analysis. The guideline is that your take profit must be 3 times as large as your stop to ensure a good risk-reward ratio and expectancy for your equity. Let's observe how this market has turned out. Here you can see how the fundamental mechanism of supply and demand of the markets works as an analytical tool. However, there are a lot more things going on in this chart, and many more details and tools you can learn to refine your analysis. If you wish to learn how to trade like a professional, check out the Fractal Flow courses in the YouTube card or video description. If you enjoy videos like these, please help support the channel by clicking the like button, subscribing to the channel and by leaving your comment below. Thank you for watching and I hope to see you in the next videos.